Hey guys, welcome back to Investing in Stocks for the Long Term. This is Tom. Today, let's talk about finding moats and barriers to entry. How do you do it? This is like the holy grail when you find something that the capital cycle is all about. Okay, look at the supply, as Chancellor talked about in the first book. We're going to focus on supply and looking for distressed industries at inflection points. You know what? This sounds a lot like being a commodity investor. And that's cool because there are not a lot of good books on commodities, hot commodities. I like Investment Biker or whatever that, Jim Rogers traveling around giving me his opinions. That's fun. But when it comes to actually how do I invest in commodities, he basically just says supply and demand. Okay, let's move beyond that. Talk about how this overcapacity leads to a reduction, and then the profits start going again and everything. Now there's some industries and some stocks that are able to avoid this cycle to a degree. The mean reversion doesn't happen as fast as you would think it would. So I've got a quick list. I know you guys don't want to sit here and look at me for 30 minutes while I tell you every little detail, but I've got several things that really are going to help you understand, do you have a stock with a competitive advantage? Do you have a moat? Okay, you want to look for cooperation. Think about it. In World War I, when the soldiers were on the front, they made deals with each other. Okay, we're not going to cross this line. We're not going to attack. We're going to just, kind of step back a little bit. Okay, businesses also do that. They kind of say, okay, we're going to, have pricing discipline here. We're not going to compete too hard against each other. Now, sometimes it may be explicit, sometimes it may not be. But the point is, especially in industries that are more simple, paper products, other commodities and stuff, this happens. It's harder to do in an industry like autos where you've got servicing contracts and financing and all the rest of it. But you want to look for that cooperation. And, another thing would be consolidation. When groups come together, and a lot of times you do have less. You're going to have less competition. You're going to have costs will be cut, and some of that excess supply is going to be going down. So you'll have a slower mean reversion of the pricing power and everything. Obviously, branding and marketing is a huge one. People know the power of brands. I mean, you look at Apple, you look at Nike, and things like that. But it's interesting to look at how that marketing actually is going to increase their brands. I mean, I remember the Nintendo Wii, which sold 100 million or whatever in 2006, 2007. The marketing was great. It was catchy. They came to the door and they say, "We would like to play." Everybody thought it was funny, whatever. But here you come to the Wii U, people don't even know that it's a new system. They failed in the name. They failed in the marketing. You can go back and watch those ads. You're just going to be scratching your heads. The marketing, even when you do have a brand, it's important that your marketing is on, especially if it's direct consumer type of stuff. Now, the example he gives in this book is Colgate. Colgate took what was more of a commodity product like toothpaste, and they just threw a bunch of money to make you think, oh, white toothpaste is out. Let's get the blue toothpaste. And hardly anybody even cared. Marathon actually asked, what their ad budget was, how they were planning to do it. So they began to actually see that, hey, this could have a big impact. Now, Colgate ended up with a 25x return from the early 80s, which did outpace the S&P, but it took it a bunch of years before it started outperforming. And the annual turnover rate was like 100% in the share. So a lot of people didn't take the time and the effort to realize what this marketing spend could really do for the company. Another one would be third parties. Now this is a fun one. Charlie Munger a lot of times asks people, what's a time you could raise the price of a product and sell more? People say, oh, luxury goods, and there is some truth to that. You got to keep your luxury goods high status. Can't discount them too much. But the answer that he's looking for is when the customer is not directly involved in buying. What's an instance of that? Think about plumbing. he mentions the Swiss sanitation company Gerhardt. The plumbers, they want the higher priced stuff. Yeah, I'm sure some of them are trying to kind of not rip you off too bad, but basically their commissions are higher. The higher price stuff that they get, and they say, oh, this helps research and development and innovation. I'm sure it does, but it also helps the bottom line a lot. And, and another one would be dental implants. You think about the dentist. He's going to get, the more he sells, the more he's going to make. The more that price is raised, the more incentivized he will to sell them. Obviously, if it gets up to a certain point, you can't push this too hard because it is a lot to the consumer. But things that are important to people like dental aids, plumbing, hearing aids, has to be custom fitted. People know I'm going to be spending a lot. What other choice do I have? I could get some cheap knockoff off Alibaba, but otherwise I got to get this thing fitted, and I got to get fitted right, and that's how it goes. So another one would be these testing products. Like if China has a product, they've got to get it tested. Their regulation in place. You've got to use this particular company, so they've got to use it whether they want to or not. Now, you also want to look at high switching costs. How much time and effort and stress would it be for people to switch from one thing to another? It's number 5. I think we're on number 5, but you get the point. Like paychecks, payroll stocks, ADS, for example. It would be a huge headache for people to switch their payroll. They'd be worried about it. So they can raise that price a little bit every year. Kind of like TurboTax. I guess that could fall out another one. People have got all their records in TurboTax. It'd be hard that's a pretty good moat. It'd be hard for a competitor to come in. People, I even think about social media, Facebook. Your friends are already on there. Instagram. If you want to start a new one of those companies, your friends aren't on there. It's a network effect. And that's a moat. That's a moat. So, another business subscription software. All right, let's keep going. You're getting bored. I can see it. All right, government help would be another one. Yeah, just put that one in there. For example, Chinese government repressed Google. Google wanted to be able to have more free speech, whatever. That opened the door for something like Baidu, which looked expensive, but really it's an asset light thing. They don't have a lot of capital expenditures. They don't have a lot of anything they have to do other than just get that search in. They're not trying to make self-driving cars like Google. At least they weren't at that time. So sometimes, the government helps you out a little bit. Number 7 would be quality over price. You're looking at people want quality. They're not primarily interested in price. Now, we talked about that a little bit when we talked about the third-party buyers, but this is even more important when that product is only a small percentage of the total price. And sometimes you do have a third party, like say an elevator or car. You've got the airbag switch. That's only, a hundredth of the car or less or whatever. And so it doesn't really matter that they're getting 90% margins from that airbag switch because it's such a small percentage, and they would have to jump through regulators' hoops, because they know they're going to have to recall the car if the airbag messes up. So they just say, okay, we know these people, we can trust these people, let's just go with this product. Another would be lab equipment. You've got to have your lab equipment work correctly. You would have to get clearance with the FDA to get another one. So you see how strong some of these moats can be. Little flavors, cosmetic products. There was a British company, perfume company, that had 90% margins, Proda, on some of their products. Vectrix, polymer used in engineering. So you can look to screen for these high return on equity. Don't be fooled by the price. Look at the returns on equity. These are the companies that have moats. These are the companies that it's hard to break in and get a competitive advantage. Monish Prabhupada talks about hidden moats and that's the holy grail, because now he still doesn't want to pay up for something like a Costco, but Marathon and Monish have both discovered that a lot of times when you find these stocks, Now, ideally, you want something that's not so known as a Costco, that's a little more under the radar from Wall Street, less analyst coverage and things like that. But you look at something like a U-Haul or a pool supply industry that just, Patrick Industries, that just continues to execute. They've got that competitive advantage. It's funny, sometimes the competitive advantages come in iconic brands like Apple. Sometimes they come in some switch for an electric furnace that you would have never heard of. Both can be effective. I think it's certainly easier to understand the consumer stuff, but it's less likely to be under the radar, so it's generally probably going to be more likely to be overvalued. So anyways, guys, I wanted to just come in, talk a little bit about these moats, how they resist the forces of what you normally see in the capital cycle. It's longer mean reversion than you would expect. Obviously, at some point, you talk about disruption, and as I said before, Marathon lost money in some of these industries that were just CDs and whatever that were disrupted out. Didn't matter what the capital cycle was doing. So we will talk more about the importance of management and other capital cycle factors in the next one. Peace out.